Hello and welcome. This is Wade Myers with the Startup Financial Model, here today to talk about why the recurring revenue business model is so powerful and why you keep hearing venture capital investors and advisors and everyone else talking about why this is so critical for entrepreneurs to try to create some type of recurring revenue stream. Okay, number one, the customer relationships tend to produce stable and predictable revenue. So we have revenue visibility. This is fantastic for a startup or early stage company to wake up every month with revenue that's highly likely to continue into the future because it's monthly subscription-based services. It's some kind of support or maintenance or other recurring type revenue. And you do start off with all of the revenue every month that you had from the previous month, plus what you sold, less what you lost. But it's a real base of revenue every single month that climbs higher and higher as long as you're growing. Now compare that to non-recurring revenue, where every month you wake up with zero and have to scramble to sell something, anything, to try to cover your overhead costs, your lease expenses, your wages and salaries, etc. And of course, when it comes to recurring revenue, contractual recurring revenue is better than non-contractual because there's a higher degree of certainty of that contract continuing compared to just a month-to-month renewal. Okay, now let's just take a really simple example to play this out. Let's just make one sales call for one new customer each month for 12 months at $50 per month recurring. That's it, just one. And here's the inputs in the Startup Financial Model app. We're just going to input monthly recurring, 12 month is the length of the relationship, and zero renewals. Let's just see how this plays out and why it's so powerful. And we're only going to sell 12 customers, just one per month for the first 12 months of our typical 5-year plan or 60 months. Okay, so here's what it looks like. So we sell one in January, the first month of the year, for $50. That one continues until December. It's a 12-month relationship, right? We add one in February, add one in March, etc. It's $3,900. 12 sales calls of $50 a month turns into nearly $4,000. And you may have heard of the rule of 78. That's because we have 78 revenue events or revenue increments, right? 78 times we're billing $50. And that's why it's so incredibly powerful. Now, what happens in the second year? We don't change anything, right? None of them renewed. We don't sell any new customers at all. We just have those 12. What happens? Well, the second year is still almost as much. It's $3,300 because basically we have those stair steps, as you can see in the background there, of the 50s going up, then we just have the stair steps coming down. So now if we look at detailed of the revenue still in an annual view, this is one of the reports. This is the income statement report from the Startup Financial Model, and we're just looking at the different items under revenue. We'll look at that first one there. You can see it's $3,900, then it's $3,300, and then of course we have nothing for year 3, 4, and 5 because we never sold any new customers beyond just that first year. Okay, so now let's just change one thing. Let's say that those 12 customers that we sold in year 1 renew at a 90% renewal rate. That's fairly high, but still not atypical for a recurring revenue business. That's all we're going to change. What happens now in the second year if most of them are renewing? Well, so first of all, in the inputs, we're just going to change that from 0% to 90% renewal rate. That's it. Now, of course, all the calculations will kick in, cash flow, balance sheet, income statement, all the financial ratios, everything will be updated for you automatically. And you can see it's $6,810 for year 2. Again, we only made 12 sales. That's it. If we dig into the income statement, detail by offering, you can see that what that revenue looks like. Okay. So now let's make one other change. Now let's say we're able to successfully sell these as 36-month contracts, not a 12-month relationship. So now we only change one thing, from 12 months to 36 months here in item number 3 on the offering screen, right? And that is now $31,590 for the full 5 years. Again, we only sold 12 customers, but they're for 36-month contracts. They renew at 90%. Look at how that revenue just keeps tracking into the future. That's what is so cool about recurring revenue business models. Okay, now let's make one other change. Let's say we go ahead and continue to sell just one new customer per month for the remaining 48 months of our 60-month plan. So now on our forecast input, we're simply adding one per month throughout the life of the plan, right? Okay, so now it's $90,000 over the course of the 5 years. Again, going to our revenue detail, there you see it. And you can see how nicely it just keeps stacking up. This is phenomenal. I mean, this is only making 60 sales at $50 each. So now, what else is there? Why else is recurring revenue so important? Well, because of all of these reasons, the enterprise values of businesses with primarily recurring revenue business models are much higher than those that are primarily non-recurring revenue. And usually it's half X, if not 3 times higher in value. So if you're going to build a business and you know you can either sell for $50 million if it's non-recurring or $150 million if it's recurring revenue, guess what? You'd rather have recurring revenue and a higher enterprise value, right? So that's why everyone is always encouraging entrepreneurs to try to create recurring revenue or turn a lot of their non-recurring revenue into recurring revenue if at all possible. It's revenue visibility, it's predictability, it's covering your expenses, etc. So this has been Wade Myers. Thank you so much for listening.